All right, well, let's talk about a few things. Presentation will focus on a few things regarding macro views that we have. And I really like this chart. I think it's reflective of a thesis that has been building at least for the last few months, in fact. And you can kind of see how these types of ideas, they sort of have a chapter to them over time. And it was inflation when we came out of COVID, learning about the history of pandemics in the past and how you tend to see this inflationary cycle after those lockdowns and so forth due to supply and all sorts of things. Then you had, after the policy response, you had this issue with interest rates that had a risk of rising substantially, particularly in the long end, the 10-year and the 30-year, because of the issuances of treasuries. The next chapter of this, in my view, was sort of this yield curve inversion. Well, initially was the inversion, and then we had the disinversion period that also occurred already. And then next after that was this whole thesis about the dollar, the U.S. dollar, of which wrote a letter back in the very end of 2024 about the bear market case for the U.S. dollar, and we saw sort of a moment where the dollar actually surged after that conviction view started to brew, and to me, when I at least see prices going away from a view that I have, it doesn't scare me. In fact, if there's enough reasons, fundamental reasons to believe in that thesis, I would say that it's only a blessing actually to be able to express that opinion at a better market position. And I would say that kind of leads to this next chapter, as we see the dollar being more challenged over time. This is not a short term, not a next week and not next 2 weeks type of idea. This is something I believe will occur over 5 to 10 years. As the administration is in my view, almost compelled to allow the dollar to devalue over time. But the second pillar of that idea is the 2-year yields, is the suppression of yields in a big way. Clearly the administration has two goals. Is the problem with the chronic deficits in two things. In the fiscal side is the fiscal budget deficits that we're running for so long, which exponentially grows the debt. But also the trade balance is the issue with tariffs and all sorts of policies now created to try to accomplish the goal of reducing the amount of imports relative to exports that we have. I don't know how you accomplish those things without drastically reducing the 2-year yield and also the dollar in terms of the valuation of the dollar. And this chart, what is looking at is two important things. It's looking at growth in GDP terms in real terms in the U.S. versus the 2-year. The 2-year yield to me is way more critical than the long end of the curve. And the reason for it is because majority of the debt, when you look at the duration, the maturity average of the treasury outstanding, is below the 5-year yield. And the 2-year yield becomes this critical and far more strategic part of the treasury curve that I view as a potential to fall substantially, given the need that we have to reduce also the deficits, and interest payments is a huge portion of that. So as you can see here, I'm looking at one thing that is called the Fed Atlanta GDP now, which a lot of the macro guys would know what it is. It's basically the Federal Reserve trying to predict where the Fed growth would be quarter over quarter in real terms. And right now it's predicting that it's going to see a substantial decline quarter over quarter. Then I took that number and I wanted to see this year over year, because that's the chart you're looking at, is adjusted on an annual basis. And that's, mathematically right now, if you look at this number, it should be actually trying to predict that, or the Federal Reserve is basically estimating that the economy would actually be growing on a year-over-year basis by almost a little shy of 1%. Now, there's been a big impact on this number that came from the large amount of imports of gold. If you include that, it's slightly higher GDP growth, a little over 1%. But you can see that when you have this situation where real GDP growth starts to fall in terms of the growth, and it gets into even a point of contraction where it's shaded in the red lines, i.e. a recession, you tend to see the blue line, which is the 2-year yield, fall substantially. To me, that's one of the biggest views, at least that I have in terms of conviction, that is yet to be part of the market. Again, that's just my 2 cents. If we go to the next chart and we just look back one cycle from here, the next chart, please. Can we go to the next chart? Sorry. Okay, there we go. You can see here that back in 2018 or so, we did see something similar. In 2018, if those recall, there was a big issue with trade wars between US and China. That sounds familiar. The Federal Reserve was being very stubborn as well in terms of lowering rates because of the issues that we were seeing. I think that's classic of today as well in terms of, I don't know if it's for political reasons. I don't want to get into that either. But clearly the Fed is waiting to see a substantial sign of the economy slowing down and even contracting before it acts. And so when you think about this, I mean, usually what you tend to see is the Federal Reserve rates, which is substantially now higher than the 2-year yield. It tends to invert with the 2-year yields as you see a contraction occurring. In other words, the 2-year yield tends to move ahead of the Fed funds rate. In some cases, or a majority of the cases, as you see the recession unfolding, by 2 percentage points. So in other words, you have the Fed funds rates, let's call it at 4%. The 2-year yields could be at 2 percentage points in that case. So you can see this big separation or dislocation between where Fed funds rate is versus where the 2-year yield is. And to me, if you look at the 2018 environment, the market did react in a negative way as the Fed was being stubborn, which caused the Fed keeping rates higher than what is supposed to be is usually what intensifies the downturn. And so, in my view, it's a similar scenario that we're seeing, and it's likely to unfold here as we see the economy having some more issues because of rates being too high on the federal interest rate policy. Let's go to the next chart. And you can see this as well in the economy itself. And most of the analysts have not really adjusted their estimates, which to me is a little bit shocking, actually. If you look at the Q2, we're entering Q2 now, earnings releases, and you compare that with the last Q2, for instance, which is what this chart is trying to accomplish, you can see that we're estimating, or Wall Street is estimating, an increase of about 11% in corporate earnings from a year ago. I'm not sure that's going to be really the case. It seems to me the estimates are very high relative to what we could see. I can certainly come up with a few reasons for why we can see a contraction of earnings. And perhaps this reminds me a little bit of the COVID impact that we had with the lockdowns and all these situations with the lack of shipping of goods and all that. I mean, we're seeing from big logistics firms basically saying that there has been a change in shipping of goods, and we may start seeing, I think Walmart had a quote as well, claiming that we may start seeing those impacts showing on to the consumers in the next 3 weeks or so. If that's the case, and we start and companies are not able to sell their products because all these goods are actually stuck in other countries, given the tariffs and all the trade war negotiations that are occurring, clearly that could have an issue in earnings that I don't think it's reflected right now in the estimates. If you look a year out, or I should say, another year out, you can see that the number is substantially higher, and it's above 20%. And so I do think that seems overly optimistic relative to what we may be seeing here. If we go to the next chart, which has been totally, I perceived as a political, way of explaining the situation, that we're seeing, U.S. airports are welcoming fewer international tourists. Is that really the reason? I don't think that. I don't know of many people, or maybe there are a few, but I don't know that the majority of people that are traveling less because of trade wars. I don't think that has much to do with it. I think that has a lot to do with companies actually cutting their budgets and doing less traveling for business reasons. I think there's a lot to do with consumers hitting a wall and also not spending as much as they used to, I think it's much more reflective of a potential contraction in the economy, globally speaking, than actually a political reason for why people are not traveling. So I take a completely different take of the title of this chart, but the data is very useful, as I just presented a case of looking at corporate earnings and the estimates that are being implicitly shown by most of those Wall Street analysts out there. Let's go to the next chart. And the next chart is something, just a reminder. Berkshire Hathaway has piled on cash over the years. I've seen this movie before, where a lot of we call it less seasoned investors, younger people, especially that have been believers of even the digital market, the digital currency market, as another way to say the crypto space, and have just completely ignored the fact that you have such an intelligent and I would say a remarkable career and of Buffett's way of investing in and holding as much cash as he has been holding. It's something that you should be at least aware and respect, rather than poke fun and say that the guy is just not as relevant as he used to be. I think this is it's an important sign. You can see this relative to his balance sheet as well. Clearly, he's holding a significant amount of cash because he's not finding new opportunities, and that's also reflective of how expensive things are in terms of valuations. Let's go to the next chart. And the next chart is a chart is something that is part of what I was referring to, and I'll get into. We talked about the 2-year yields and the potential for the decline of interest rates in the U.S., especially down the curve of the 2-year, in my view. But that should have an impact on the dollar. It's the fact. Remember that idea that the U.S. is spending close to 4 to 5% of interest payments to GDP, while Europe, for instance, or Japan are paying less than 1% in some cases. Europe is, I'm referring to the Euro countries, but if you look at Japan as a single economy, you've got it 0.9% of interest payments to GDP. So Japan is in a better position to raise rates than the U.S. It's a very unpopular view that, as you can see, if rates need to fall in the U.S. and they have to fall more than other rates elsewhere, that usually has an impact on FX. And hence why I think that if you look at the DXY index, which is one way to look at the dollar performance versus other fiat currencies, there is a potential that the dollar could fall much further. And then you look at this 10-year rolling change, we're just starting to get into that negative camp of that number, as you can see on the second panel of this chart, which is taking a 10-year performance of the dollar rolling over the years. You can see that a lot of times we see multiple years of that 10-year rolling performance in a negative front. For those that are more short-term thinkers, of which I am not, the 10-year, the second panel of this chart is completely meaningless for you. To me, it's extremely meaningful, because if I have a view that yields are going to be capped, most likely, and I also have a view that the dollar is at a situation where it needs to be devalued relative to other fiat currencies for trade balance issues, or just because things are way too expensive. I mean, we have a dollar that is as expensive as it was before the Plaza Accord. What does that mean? And I'll go to the next chart. And the next chart, I'm just showing euro breaking out. It's one example. These things, they take time to develop. When you show a chart like this of all the way back to 2006, and you see a breakout of the euro like this, these are very meaningful moves. And a lot of people tend to get very bullish on the euro after the fact, after you see a breakout and so forth. And to me, I think these things take time to, you're not going to see a straight line, just like any other asset. In the way these things behave is usually currency trends tend to take a long time. They usually very long term, ideas that tend to play out in markets, and usually they're linked to other things as well. And so keep that in mind. You have the dollar changing in a big way, potentially entering a long-term fall, or the euro entering a long-term appreciation potential. And the other side of it, you have interest rates being, challenged more and more to drop. That means that the next chart should be about where I also think there's opportunities, which is emerging markets. As we see the rebalancing, which we'll talk about this in a minute here, emerging markets are something that comes to mind because they're just incredibly undervalued, historically speaking. In many ways, you can look at relative to fundamentals. You can look at, in this case, it's a calculation of money supply. So you just look at the market cap of Brazilian equities relative to money supply, and you can see that prior times when those equities were as undervalued as they are today, it marked significant bottoms. There was the COVID crash or the Brazilian political scandal that we saw back in 2015, 2016 during the car wash, or the global financial crisis bottom, or even the early 2000s. And none of those bottoms are easy to call, none of them. And I'm not here to claim that buying low and selling high is an easy thing to do. It's extremely hard. And usually there are reasons why things are cheap. And that's not the point at all. I mean, these things are volatile, they're risky. However, there are moments where when things, are basically already implicitly, I guess, in the price in terms of the risk. That is my opinion. I think that's, mostly in the price and a lot of those risks. And I believe that if you are entering a world where the dollar and yields are going to be challenged lower, I think that emerging markets, those are usually the big, macro risks you have for investing in emerging markets. It's competition elsewhere, because the risk, structurally speaking, it's not like Brazil will change. When usually you show this chart, people will say, well, there's political risks and all that. I'm not claiming that's going to change. That will be the case 10 years from now, most likely. It's just the nature of an emerging market. Brazil has been an emerging market for 30 years. It's never emerged to become developed, and unlikely will become developed. And it's not that I'm picking Brazil in one way. I mean, we did an investment in Bolivia for 6, and there are other economies that look just as attractive in my view. I'm just picking one of them for the sake of the presentation. But let's go to the next chart, because if you recall, Scott Basson this week did a very important presentation where he talked about, well, the main word, I think the whole presentation should be about one word, which was rebalancing and trade fairness in terms of relationships between countries, and rebalancing likely to happen of the U.S. not being such a massive importer of goods. Okay, well, if we're going to see that, let's talk about the elephant in the room, which is this chart. It's the rebalancing financially speaking. It's the rebalancing of 73% weight of U.S. equities relative to else, nowhere other. There's no other country that has even double-digit weights today in MSCI World Index. And so I think that rebalancing is sometimes when you try to fix one issue, you basically could trigger other unintended consequences. And I think that by doing what the Trump administration, rightly or wrongly, doing in terms of the trade rebalancing that we're seeing, may actually trigger a rebalancing financially in terms of the weights of equity markets and also the currency aspect that I was talking about of the dollar being challenged. Let's go to the next chart. I'll try to get my skates on, so go quickly. And so you can see here, the gold to silver ratio had a big move recently. Silver was actually rising on a day that gold was falling. There has been a lot of attention over gold being overbought and maybe even overvalued. That is not my view at all. I don't think that's the case. You can look at gold relative to money supply. You can look at gold relative to treasuries outstanding. Gold has been an anchor for monetary systems for a long time. If we put, just a disciplinary hat and look at relative to other periods when we have monetary realignments, which I think we're facing now, it would suggest that that gold prices can see, drastically higher numbers, and that's just research of history. That's not, targets or anything along those lines. At the same time, it's very difficult to ignore the fact that we've had one of the biggest gold to silver ratio declines the other day. I think it was 2 days ago, on a day that gold was down substantially. And a lot of people focusing on the gold side instead of focusing on the silver side. And at that time, when we saw it was October of 2008, that marked the beginning of the declining trend of the gold to silver ratio, of which that ratio went from a 85 all the way back to 30. That would imply, just to give you some sense, if we go to 30 on the gold to silver ratio, that would imply $110 of silver prices per ounce, just using the ratio. If we go to the next chart, we're going to look at the history of the gold to silver ratio. Again, there's two types of investors: those that look at this type of chart and say, well, this time will probably be different. There's reasons why the gold to silver ratio should be above 100, and most likely, we're entering a different era. I'm not a believer of that. I look at this chart and I think, all right, how many times have we seen this above 100? Do we stay there for too long? No, very unlikely. This is over 120 years of history. Okay, well, that's relevant. And at the same time, I have a view about gold. We have a view about gold. And also we have a view about silver. Silver has played a monetary aspect and has played a monetary role in the global economy many times in history, and could certainly play it again. And it's usually the case when things get too cheap, they become more industrial. And so it doesn't mean that it's a structural change of the demand of silver, but rather just the fact that it's just so cheap that it's being used industrially. But as you see silver prices increase, which is my view, and I think everybody else's views here, that changes. It creates a demand from a monetary standpoint. I think we're going to get into that world as we unfold here in the following years. Let's go to the next chart. I'm almost done, Quentin. This chart is just basically saying, what we've been seeing recently of gold prices rising. I think there's, you can create all sorts of rumors and think about logically what's been causing gold prices to rise recently. Well, number one has been central banks. They've been announcing they've been buying gold, and gold has been rising regardless. So I caution people that using technical analysis for when you're at a turning point in history of seeing a monetary realignment, which I'm using the term specifically from Scott Batson prior to becoming the Treasury Secretary in prior interviews, you can see clearly that people are rushing to buying the metal for other reasons outside of technicals. And so using technicals for trying to time 5 to 10% moves in gold up or down, to me it seems very irrelevant given the significance of history that we're facing right now. And it wouldn't shock me at all if the yellow line, which is in this chart, yellow line is showing the gold reserves by the US, and the blue line is showing the gold reserves by international central banks. It wouldn't shock me at all if the yellow line is the one actually causing gold prices to rise. If we think about it, that's just my view. If we think about it, clearly the U.S. administration is incentivized to see gold prices to rise. If we want to revalue gold or do something along those lines, which have been talked about also all over the media, in order to increase the collateral value of the TGA account and increase the the cash balance of the TGA account, and be used for treasury buybacks and other things. The toolkit that Scott Batson has often mentioned. One way to do that is by seeing gold prices rise. And so I'm just saying that everyone is incentivized to see gold prices to rise. It's another reason why, to me, looking at overbought indicators, it seems a little bit irrelevant to where we are in history now. Let's go to the next chart. I think I'm almost done, if not done. But the other thing that comes to mind as well is this chart, because it's the catch up to gold. Gold has had a very big move, and a lot of commodities are extremely cheap relative to gold. And this chart is a good way to show that. It's not just oil, it's copper, it's silver, it's platinum, it's agricultural commodities. All these things are really cheap and usually are linked to gold. If you look historically, gold prices rise, they usually have a correlation with other commodities. It makes sense. Their natural resources are interconnected usually, and they have moves, that tend to be balanced. And so I suspect that the catch up of other commodities is potentially or arguably an even more interesting idea than saying gold is overvalued, but rather that other commodities have some catch up to do here. I'm a firm believer of that idea as well. Let's go to the next one. I think I'm almost done. And last thing I wanted to point out, I guess, is the overvaluation of the S&P. I mean, I've shown a lot of charts just now, commodities to gold ratio. Look at the S&P 500 to gold ratio. How overvalued are we right now? Where are we again at a point in history? We're just as high as we were back in 2019, 1929, at the very peak of the bubble that caused the Great Depression, which was a time when tariffs were imposed later on, but maybe the market was acting ahead of some of those issues as well. I just want to point out that things are very frothy on the financial markets side of asset classes, and gold is extremely cheap from that perspective as well. So, anyways, that's just another way to see how the whole global economy is shaping up.